Hi, my name is Eric Brown, and I'm a portfolio manager at Graham Wealth Partners, which is a member of the Canaccord Genuity Wealth Management family. Tonight, I'd like to welcome you to join us for the discussion on tech investment in Western Canada. Today, we have five special guests with us today. The first is Kevin Brent, who's the Vice President of Reach. The second is David Banka of ICM Asset Management. Carla Blonsky, the co-founder of Quip Accelerator, Zach Storms, the co-founder of Startup TNT, and Mike Wilson, who is the CEO of Drug Bank. I hope you enjoy the discussion tonight.
We're excited about being here today, and thanks very much.
Great. Thanks, Dave. Carla?
Great. Well, thanks for having me, Eric. Glad to be here. As Eric mentioned, I'm a co-founder of a new tech accelerator that's being set up in Western Canada called Quip. For those who aren't familiar with the term, accelerators work with entrepreneurs in scaling companies, and they offer education, mentoring, and connection to investors. They traditionally wrap up each cohort with a pitch day where all the participating companies get to present their ideas. Quip takes a slightly different take on this. We are a fund-backed accelerator, which means that in addition to the coaching and the courses that we provide, we also operate a venture fund that takes equity in companies as they go through our program and also does direct investment in select alumni when they've completed the accelerator courses. As well, Quip is unique in that we also offer a post-accelerator program. That's designed to address the main pain points that investors and companies have when they get together in scaling companies. What that model means for investors is that Quip handles all the upfront headaches in terms of sourcing companies, vetting them, and working through valuation with the entrepreneurs before we invest. It also means that because we work fairly intensively with the founders and the senior management team over 3 to 6 months, we get a chance to do extended due diligence. We see how the companies operate, how the tech gets traction in the markets, and that helps inform a bit more in-depth understanding. And finally, it lets us create a diversified portfolio in the range of 150 companies over a 5-year period. Probably most importantly, this model also allows us to offer to our investors in the fund access to proprietary deal flow in our alumni. And those opportunities come to investors only after the companies have completed that post-accelerator programming that's prepared them to take in venture investment. Overall, it's an efficient model for people wanting to participate in high growth and scaling tech companies.
Great. Thanks, Carla. Kevin, you're up.
Yeah, so as mentioned, I recently made the jump from the investing side over to the operating side with Reach. And so Reach is Calgary-based. Guess it's a scale-up stage now. So they went from 30 employees, I guess, 10 months ago to over 100 today. And without having actually raised any external capital. So I jumped over there as they were having conversations around, what would this look like if we actually put fuel on the fire? And after spending a fair amount of time with management, looking at the plan and everything else, I made the jump because if you get the opportunity to join a rocket ship, you can join the rocket ship or invest in the rocket ship, which is what we're all here to talk about. So what Reach does is we localize cross-border e-commerce payments. Which basically just means that we provide a merchant with the ability to not only show their prices in the local currency of the customer, but also process the payment locally, which increases their cart conversions, gives them much more flexibility in actually keeping their brand, keeping control of the checkout, everything else, and reduces the amount of fraud or declined payments. And so that's what I'm doing now.
Great. Thanks, Kevin. Zach, go ahead.
Yeah, thanks, Eric. Happy to be here. And Startup TNT is an organization that started with a happy hour. Our philosophy is have fun, make friends, build companies. We've been meeting every single Thursday since May 16th, 2019 in Edmonton, 126 weeks now. And we actually now also meet in Calgary and Saskatoon and sometimes Regina. So if any of you are in Calgary, join us at Craft downtown on 10th. And in Edmonton, we're meeting at Campio on Thursdays. We also run this investment summit, which is a way to both train new investors and introduce them to angel investing, but then also actually invest in great local companies. We're actually running one right now. I'll put a link in the chat for the event that's coming up on November 18th, where the investors will make their investment decision live. Each investor is chipping in $5,000 upfront to go in on a deal. And to give you a sense of some of the great companies that we like to invest in, look no further than Mike Wilson from Drug Bank, who raised money at our very first investment summit. So anyways, that's
it was also a lot of fun.
And I'll also add, actually, Kevin's former company that he worked with, Blue Sky Equities, has invested with us in some of our summits in the past. So try to bring the investor community together and have some fun along the way.
Include Drug Bank.
Yep.
Great. Thanks, Zach. Before we get started, I just wanted to mention that I don't know if we're going to have enough time to open it up to questions, depending on how it flows. But if you do have any questions, please write it in the chat box, and we'll make sure that we answer the question either today or as a follow-up later this week. So we'll start there. I guess one of the big questions is investors have is, especially if you haven't invested in venture before, why should you? Why is venture investing important? Why should it be part of a portfolio? And what are the benefits to investors to actually invest in this space before we dig into different parts of it? So we'll start with that question. David Vanka, if you wouldn't mind starting there and getting into that, and then we'll open up to the other panelists as well.
Sure. Yeah, and I think everyone should take a look at their whole portfolios and not look at sort of one-off investments as they come along. But the one thing about technology that's really exciting is there's no other sector that shows the same growth as technology, and probably 7 or 8 of the top 10 fastest growing companies on the Fortune 500 are technology driven companies. And even if we look at the changes in sort of the balance of power and things like the Dow and other indices over time, it looks dramatically different than it did 10 years ago and certainly 20 or 30 years ago. So, the primary rationale here is the growth these companies are providing, and the fact that technology's disintermediated borders in many ways. And even we've been focused on companies with head offices in Western Canada, but the majority of them have customer bases that are in the US or global, and we see no exception there. So some of the barriers that perhaps used to exist in our regional markets don't exist anymore, and we think that comes with a ton of opportunities. The other thing about a lot of the sector is these companies are scalable and falls into the growth model, but they can be exponentially scalable in some cases. And again, locally, there's been a number of successes we can point to, but certainly in the US and other markets, we see it and use it every day as we're becoming more connected with our behavior. So, and with the sector itself, I think the other thing that is clear is you're not necessarily just investing in technology companies as a sector, but so many of our traditional industries, whether it's manufacturing or transportation or energy, are being greatly enabled and transformed by rapid adoption and use of technology. And it's required to become efficient, productive, reach customers, everything else. So it kind of intertwines our entire market, and I think it deserves a pretty meaningful part of people's portfolios.
Great, thanks, Dave. Zach, if you wouldn't mind commenting on that, because obviously one of your mandates is to bring investors to the venture space. So what is it of interest that's bringing these investors to it? What are you telling them that's the benefit to it?
Well, I think there's 3 reasons to come to mind, and I think David just really hit on one. And a very important one when we're talking about money is it's actually a good investment. You can get a really good return on that investment. It's a great financial opportunity. We just had a discussion as part of our investment summit about what does a typical family office diversified portfolio look like, and it's only 30% in publicly traded equities and 10% in venture and another 30% in private equity. So I think like, that's a lot of us that are from just like a more regular background. We don't have our own family office. We're really overweight on public equities. And I think the opportunity to diversify your portfolio, especially in local startups that are very promising, is a very exciting way to participate in that space. And then two other things that, in my opinion, are actually equally important are that it's a lot of fun. You're building relationships with great people. You're meeting very exciting individuals like Mike Wilson, who are building these awesome companies. And you get to participate in this very small way, but it's very exciting. And then it's a way to impact your local economy and your local community in a very meaningful way that you just don't get when you invest in publicly traded stocks. Like it's cool to invest in that awesome company out of the US that's doing great things. But as a tech investor, you get to invest in that awesome company that has offices downtown and you see their team when you're going for coffee at dusk. Like that's just a very cool experience to kind of see that happen right before your eyes.
Yeah, great. Any of the other panelists, do you have any other comments or anything to add on the topic?
Yeah, sure. I'll expand on that. I mean, the goal though eventually is to become overweight public equities when one of your angel investments IPOs. But that the beauty of it, and I just to reiterate on both of those approaches, is it's so important to take a portfolio approach. I've seen a number of investors when they first want to dip their toe into tech investing, they write a $250,000 check into the company that they see that they're like, oh my gosh, this is going to change the world, and the failure rate is still very high. And so, the way that I like to explain it is you're much better off splitting that into 10, $25,000 checks to get your allocation, or even broader, but over a set period of time, because again, you can only lose 1 time your money, but this is an asset class where you can have 100x outcome. And so that really is what's going to drive those returns, is finding the one outlier in that distribution of returns. So
Yeah,
definitely want to take a portfolio approach to this asset class.
Right. I think that brings up an interesting point too, where we've been talking about the opportunities, but there's also risks to venture class, but also risks to not having venture in your portfolio. And I think that it helps for that diversification model as well, that when public equities are going up, maybe venture capital is not, or vice versa, to provide that the correlation reverse, or the uncorrelated asset class, or not as strongly correlated. Mike or Carla, or any other comments on that piece?
Yeah, I'll talk a little bit more about risk. And I think that's one of the things that puts off a lot of investors who want to get into tech investing, is they don't necessarily know how to assess risk. And companies at different stages of evolution of the tech, companies with different tech sectors have different risk profiles. So to build on what Kevin and Zach said, is by having diversification and getting involved in multiple companies, you get the diversification and you mitigate the risk. So if you can find a creative model for doing that, whether that's through Startup TNT, Quip, through smaller investments in a lot of companies, or working with other angel networks, I think it lets people get to be part of what's a very exciting field. I come from a tech background and I'm very geeky, so I've always been excited about tech investment. But I think right now, more than ever, it's the time to get into that. If the pandemic taught us nothing, it was that tech can solve pretty much any challenge, and you've seen it across all sectors. So yeah, I can't any more strongly say that it's an exciting time to get into this.
Yep. Yeah, I agree. And I think we'll probably talk more about that, but it's definitely an exciting time to invest in tech. There's been also, so many changes in the world, which has also meant a lot of disruption, a lot of opportunity as well. So there's many changes happening across a lot of different industries, and that tech is enabling. So things are moving quickly. A good time to hop on.
Yeah. So I want to continue with you, Mike. So you've started a company, you've raised money. So what would you say are some of the challenges that companies, or that you in particular face? Do you have any stories of, hey, this is a good investor, this is one that was a pain in your butt, or lessons that you've learned from it, or things that from the company perspective on investing in the space?
Sure. Yeah, so I mean, one challenge for us when we first started out is it's a challenge to when you're pre-revenue and you're an idea, going from that phase and looking for investors at that early phase can make a huge difference for a company. But one challenge we had originally was looking at the local investors. There's not as many local investors that were used to investing in pre-revenue companies, I guess. And there's different milestones you're looking for at that stage around traction or proof that your technology is working, proof of your product market fit. And so that was a challenge, but that has changed quite a lot over the last few years with things like Startup TNT, or I think just sophistication is changing. And then also the access to investors in other locations is very different now as well. It's much easier to contact. Well, one, willingness is different for investors from the States and things like that as well. So lots of things have changed there. The ecosystem, there was Startup Edmonton was a really important thing for us back when we first started to kind of get connected with the community and start learning more about how to start a business. So, but today there's a lot more. There's a lot more companies and a lot more different parts of the ecosystem. So it's matured a lot. And people like Zach have had a lot to do with that. But also lots of these startup companies have been growing and scaling, and that's actually a really important opportunity for learning from your peers as well. So there's a lot of challenges that have actually improved over the last few years. There's been so much growth in the local ecosystem for startups. So,
right. And do you think there are new challenges based on the way that things have changed? New challenges?
I mean, there's always challenges with starting a business, but I mean, there's the challenges that come to mind right now are there's so many challenges with COVID, obviously, and the uncertainty there, but it also creates other opportunities. So I always there's so much has changed over the last couple of years because of COVID that it's hard to even think about the other kinds of normal challenges in some ways. But a big challenge right now is around talent retention. There's lots of shifts happening in lots of people switching companies these days with more remote work and more remote recruitment. And so that's a big challenge. And then, culture is such an important part of a company. So how you're growing your culture in this environment, dealing with mental health when you you're going through a pandemic, and making sure your employees are happy and productive. Those are big challenges. And they've been good learning experiences for us. I think we've become stronger as a company because of going through a lot of that stuff, but it'd be tough when you're starting out trying to build a culture from scratch. I think there'd be a lot of new challenges with that I didn't have to face. So.
Great, thanks, Mike. I know Carla and I were talking earlier about some of the changes in the investment landscape previously. And so Carla, if you wouldn't mind expanding on the conversation we were having.
Yeah, sure. Most of my career has been working with startup companies down California, San Francisco, San Diego, Seattle, New York, Madrid. And it's only recently that I came back to Canada, and I was quite surprised how much the ecosystem had changed. So before I went south, really the challenges were that investors locally did not give the valuations that you could obtain down south. And the speed at which they turned around deals was so slow in an industry where you need to be fast and adapt quickly. So that created challenges. And you saw a lot of good companies that either had to exit too early in M&A activity and not get the returns they could have for their investors, or companies that were asked to move down to the States. Coming back now, as Mike said, that's changed so dramatically. The location of a company matters less, and the challenge comes with that. It's a double-edged sword. As you get investment from other jurisdictions, we have interest from Asia, some Asian investors to come in through the equip, is companies will have to be able to manage those investor relations with an extra level of complexity when it's not just local investors or people who are familiar with the local ecosystem. So I think post-pandemic, as we get more of that global investment coming in, that's going to create some new challenges, that founders are going to have to navigate.
Yeah. Dave, Kevin, or Zach, any comments or?
Sure. Yeah. I mean, a couple things to add to what Mike was saying, on the challenges. I mean, in our experience, the feedback we receive is similar on the talent side. Retaining and keeping talent is a challenge across the industry. And at the same time, we need more and more of our kids to go in and work in this space as well. But, there's also been opportunities from that, not just with local people, but with the US in some ways closing their borders to visas and the like. We've been able to attract some people to Canada that we otherwise could not attract. The second challenge, it's maybe been an Alberta-based challenge, historically it's been difficult to get our own customer here. A lot of the companies we've dealt with, they've given a lot of that feedback, and it's been easier to get a customer down in the States or somewhere else to start, and that's something we want to see evolved over time. But all this plays to opportunities, I think, in Western Canada as well. Carla mentioned valuations, and even though we are seeing more international investment coming here, we can still move into companies at earlier stages here at valuations that are, a fraction of what they would be in the US for the same concept, same idea. And with the ability to touch on that whole customer case, we think that's a great opportunity to get in. We've had a number of portfolio companies which have gone from local bootstrapped investors to having US-based VCs there. And I think within the prairie regions in particular, and parts of BC, perhaps outside of Vancouver, which is fairly saturated, there's less competition in terms of sourcing investment, and we see the opportunity base kind of continuing to grow. And as the world evolves, now that we're seeing successes, whether it's companies like Jobber at Edmonton or Solium being sold, Benevity being $1 billion company, et cetera. There's been, Cement's a fast grower in Calgary. These companies are going to spin off their own companies as time goes on, and they evolve, not dissimilar to how Research in Motion helped develop Kitchener-Waterloo, or Shopify's helping change Ottawa. So I think we're just going to continue to have great mind share and ideas coming out of what is a fantastic part of the world for people to live in, an affordable part of the world for people to live in. So the quality of life component is material, and we just have to get that message out there.
Kevin, I have a question for you in terms of with your experience at Blue Sky. So we're talking about from the company perspective, but also from the investor perspective. What challenges did you see in the Alberta market looking at investments or looking at companies that were coming to from the investor side?
I mean, I don't know if any of the problems are necessarily specific to the Alberta market, and companies that have gone through a good either incubator or accelerator or something like that often are better prepared when it comes to their investment pitch or just the business in and of itself. But at that really early stage, whether that's sort of pre-seed, maybe they're pre-revenue, they've got one customer, something along those lines. Oh gosh, to list them off, there's many, many, many reasons to pass. As an investor, you're just looking for them, right? So you've got to be able to preempt all the different reasons that, and whether that's really knowing your market, right? Answering, oh, there is no competitor. There's always a competitor. There's a substitute. You got, some business software. Well, your competitors Excel. Sure, there's nobody else doing the exact same thing, but are you 10x better than a spreadsheet at a fraction of the cost, right? That kind of stuff. So but at the end of the day, the most important thing for founders to get across is why they are the person, why they are the team to be able to execute. Who are they going to hire and attract, right? And then as that investor, you're sort of looking at that, because as a CEO, and Mike can probably confirm, his job is to build an amazing team that can execute on his vision. because you can't do it by yourself. And so, you know, to go back to the comments about talent and everything else, it's really like, how are you going to really get everybody behind you and build out this vision and execute on it to the point that your business is going to be that hyper growth company that every single one of us is looking to invest in. So really getting that from all the way from the elevator pitch to the extended appendices in the slide deck when you're going through the due diligence process. It's always focusing on being that profit, not just to the investors, but to your staff and to everybody else to sell that vision, because that's what makes that sort of pre-seed before you have metrics. You don't know what your cost of customer acquisition is or their lifetime value or anything at that stage. So that's the key component to getting successful investor capital at that point.
Right. And you mentioned a couple things that you as an investor are looking for. So I'll open it up to everyone. Are there any specific things that you as an investor are looking for in a company? Really to give a perspective to the people in the room here that if they've never done it before, what makes a good investment? What makes a good venture investment? So a couple things that you look for. So that's Zach. Do you want to start?
Sure. I mean, I would just Kevin. I think Kevin hit on one of the most important ones. That is that at these very early stages, there aren't a whole lot of metrics to measure. There's not a whole lot of history to measure. And so you're looking for the team's ability to execute, and have they accomplished? What I like to look for is that the team's been able to accomplish something impressive with a small amount of money or no money. And now, as an investor, you're going to give them money, and they know exactly what they're going to do with it. You can feel confident that they figured things out, they've gotten somewhere, they're onto something, and that's how I'd summarize it.
Great, thanks, Zach. Carla.
Yeah, I'll add on to what Zach said. I think, going from the early stage startup to scale up, companies have some market traction. They've launched a product, maybe done a pilot with a couple of sites, and that demonstrates that they can achieve something, that there's pull from the market for their product. But what we see as a gap pretty consistently is the companies can't articulate a go-to-market strategy. So they can end up drowning in all the opportunities that they face. And if they don't have a codified process for prioritizing those opportunities and assessing strategic fit, likelihood of obtaining revenues, market size, and being able to express that to investors, that's a bit of a red flag, because you can have all of that traction, but that doesn't mean it translates into that accelerative growth that investors want to see at that stage. There's a lot of companies that continue along on a nice steady progression, and that doesn't lead to returns that you want to have.
Yeah, to echo on what Kevin was saying, I totally agree. This is a lot about the founders and not only having the vision, but by believing that they can execute. And none of these companies ever go in a straight line from day one, and they certainly all have the same wonderful projections the first time you see them, second time you see them. But the reality is it's hard to be an entrepreneur, and one of the things, I mean, we've seen through COVID, and Mike mentioned it, is that how do these founders do through this adversity? Because a number of the companies were kind of in two halves here. One, they're dead in the water if they don't change something because COVID dramatically changed their business for the worse, or two, they've been given some great opportunity to accelerate because their business is so suited to remote work, telehealth delivery, whatever the case is. Now, how are they going to manage it? And then going from being a startup to now a scale up with employees and people and things like that. So, looking hard at the founders is critical. And, as Carla said, diversification is also critical. And it's hard for individuals to do that necessarily, but no matter how great you think something is, doesn't mean it's going to turn out. So it's and similarly with the sectors or where the macro opportunities are going, you can't necessarily predict that either. So it's important to have a basket and figure out which stage you're investing in across the ecosystem as well. So,
yeah. Good points, Kevin or Mike. Any additional points, or anyone else? No.
I think, and I guess one other comment, Carl, Kevin had mentioned and Carl had mentioned, having a number of investments. One of the things you can do after you've been with them for a while is if you've got your portfolio, you might have a handful of companies that are going to the next stage, as Drug Bag started as a pure startup and is now evolving. There are other companies in your portfolio you can say, this one's doing well. Even though the valuation's higher, I feel much more comfortable with their ability to now go from what's gone from 5 million to 25 million. Now I can actually believe they can go from 25 to a billion or a billion plus. And that won't be every company in your portfolio, but those are the ones you might write the bigger tickets on as you see them. So I think it's important to keep a little bit dry powder for follow on with some of your winners that are in your portfolio.
Startup TNT sells $5,000 options.
So,
but they have to be exercised at the end of our summit.
Yeah. I've heard or seen some stats, depending on the different sources, but returns in venture 20% plus, all that kind of stuff. And I've had comments and discussions with people, oh, that sounds easy. I would love to get those returns. Obviously it's not easy, but what would you say is the biggest challenge that an investor faces to getting solid returns in the space, the 20% or higher, to be able to get to that point? Kevin, we'll start with you.
Well, maybe I'll answer Bruce's question. I think it's 30. Now you've got the risk of like over diversification, and you can, right? Like whether you've got 50, 60, you could have 100, sure. It comes down to, the odds of you actually hitting. You could have 100 early stage investments and not actually hit a like unicorn multi-bagger, right? And of course you have one. So it's sort of getting to, what's the point of diminishing returns? I know Carla was going up, and it's right, but at the same time, it's
No, I'm agreeing with you. The 30
okay.
was the number in my head.
Yeah. So I'd say 30. And so from that standpoint, taking the strategy of writing small checks at the very early stage, I used to literally call them call options on the company's future success, because you take a small piece, you get to know management, you're on their investor list, they're communicating with you, you get a better feel for all of those other qualitative metrics that are super important in this space. And then you can decide whether or not to follow on, as David was saying, in order to enhance the sort of probability. So.
Yeah, no, that was a great segue into the diversification piece. But Carla, it looks like you're about to say something.
Oh, yeah, I was going to say one other consideration is for someone wanting to invest in tech is whether they have the bandwidth to handle that kind of level of diversification. There's stats out there that says, the average amount of time to close a deal, to source it, vet it, negotiate is about 118 hours per deal. And that also calls into question whether an individual investor wants to devote the resources and develop the expertise in each of the sectors they're looking at to be able to do what I would consider solid due diligence. So that's where groups like Startup TNT and these other groups like Quip give a mechanism to hand off some of that upfront work and let you participate and let you get the insights that Kevin mentioned into companies before you write those follow-on checks.
Yeah, Eric, I put sort of that access to top quality deal flow as kind of the number one issue. And actually,
Okay.
Carla brings up a really important point here about how long it takes to close a deal, to vet a deal, to figure out, all of that is a lot of time and effort, which is why we love the approach at Startup TNT, which is really for hobby investors, angel investors that aren't doing this professionally full time, but are doing it among friends and basically pooling their resources to do all that together as a team.
Okay. So to expand on that, what is top quality deal flow? What does that mean?
Well, that's a good question. I would say that our thesis at Startup TNT is, we like to invest in the beginning stages of a company's journey, ideally. So roughly between friends and family going in, probably post friends and family, but roughly like their first major round. So top quality deal flow at that stage is the most ambitious, most highest quality local entrepreneurs in your ecosystem that have identified a really promising opportunity. And I think that a lot of times it's still, at least at this stage, it can still have a lot of unanswered questions that the entrepreneurs are going to figure out along the way. And so I think that, you know, when you want to go in these stages where the opportunity is massive and the valuation is still quite low, you know, the deal might not actually look beautiful to you. It might look like it's got a lot of wrinkles. So I'll just leave it there.
Okay, great.
Yeah, I think, and I think from that, once you get to that next stage, or later, it evolves into something that becomes, you know, demonstrated that the founder's been able to put a team together, that their market fit looks like that's something that they can access. They're perhaps have a customer or two. They've got a plan. The governance side of the business, which we haven't really talked about, but usually starts like a dog's breakfast, and they're getting to a point where they know things like how many shares are outstanding. They're starting to put together a board. All those sorts of things moving forward is the next stage, and then being in areas where there's some perhaps demonstrable moat for what they're doing. So like Kevin said, there's always substitutes or competitors. So there's a reason that what this particular company is doing that's different or not easy to duplicate, where they have this moat around them that gives them the ability and some running room to scale. So I think every stage is a little different, and the larger, more deeper, if you're investing in, you know, the Benevides and Siemens and some of the hundreds of millions to, you know, billion-dollar companies that are still private but in the venture space, you need a much smaller portfolio of those than at the beginning, obviously. So, but your returns are going to likely be your return expectations are likely going to be lower as well for any individual company.
Great, thanks, Dave. And Carla?
Yeah, I think it comes down to the quality deal flow depends on where your risk profile is, because there's a fit for certain investors who love that early stage, you know, like startup TNT, where everything's possible and you can help shape that, you know, particularly if you're a hands-on investor. For Quip, we take a sweet spot where there's been enough of what David said in terms of proof of concept and market validation, but before, you're right on that inflection, before the revenue scale and valuations go up. So it's balancing return and risk. And I think what is quality deal flow for one investor is different than another, because their expectations of return and their tolerance for risk vary. Knowing where you are on that spectrum helps you kind of hone in on where you should be investing.
Great. Anyone else comments on that deal flow? No? Okay, I'll move on to the next. Where we're getting.
Eric, can I just, Bruce Alton bring up this really good question in the chat here that I was kind of corresponding with him about, which is, you know, we're still a relatively young community, and we still don't have a lot of tech investors and angel investors that have invested in a portfolio that's produced amazing returns that they can point to and share that story with other investors. So just a few of us kind of commenting on the chat there, how important it is to really like drive home the point that, yeah, you can invest in great deals here in Alberta. And see, the thing is, if you wait until you meet all those investors another 5 or 10 years, you'll be too late to the party. So you have to have a little bit of a belief now that the deals do exist and they're happening. And people like Mike Wilson are driving them home for us over the next few years. But anyways, that's all I'll say.
Great. Well, that actually segues into the next question, which is perfect. You must have known what it was. So the question is, we've seen some incredible growth in the ecosystem here, but obviously there's room to go. And so what would you say over the next 2 years, what are you most excited about? What do you think the biggest trend is, or opportunity, or something that is really going to stand out when looking back on it 2 years from now and saying, oh yeah, I'm glad I was a part of that. So I'll throw that out to any of the panelists, if anyone wants to dive in. What are you most excited about in the next 2 years?
Well, I'll kick off with a reference to COVID. Is we are facing a crisis in terms of funding for healthcare. So I think I'm most excited about technologies that use data on patients to reduce healthcare costs. You know, we are now collecting huge data sets that track a patient all through their life. And that means we can identify people who are at high risk earlier. We can do less invasive treatment regimens. We can improve outcomes and reduce the healthcare budget, particularly for, you know, gerontology and older populations. 60% of healthcare budget in your life is spent after you're 65. So things that we can do with that data early, whether it's through devices that are worn, some of the med tech's really interesting, some of the data analytics companies are very fascinating to reduce that healthcare burden. I think that's an urgent need that's going to be an interesting area to watch.
Anyone else?
I'm a bit biased towards certain spaces as well, but I would agree with Carla. There's really a lot of opportunity in the health space, not just in healthcare delivery, but all the way down to, you know, drug development. And there's still so many opportunities to leverage data and leverage recent advances in AI. And I think there's similar opportunities in other business sectors as well for leveraging AI to, you know, change the way that things are working in that sector. And the friction for business to business sales is a lot lower, I think, because now it's just sort of the norm all of a sudden to do virtual meetings all the time. So it's actually changed the game a lot for selling your solutions globally. So I think there's a lot of opportunity in those spaces.
Great.
I can add on to that too. I mean, our number one is also in the health space, and it's a specialized area to invest in for sure. But I mean, advances in healthcare. I mean, this was an industry that was, you know, I mean, they still have faxes there, but it was stuck in the dark ages for a long time. So not only the data sets Carl was talking about, and even in Alberta, I mean, AHS has a massive data set where, you know, with access to it, I mean, that can lead to new outcomes and opportunities as well. But prevention and just the size of the opportunity there, and you know, it's not super common knowledge, but there's companies like Circle Cardiovascular, Orphix, other companies coming out of Alberta, which are showing success on the global stage. So it's great to see. I think a couple of areas that I like is certainly clean water and food is going to be a macro theme, I think, for decades to come here. So sort of that broader ag tech space is really intriguing. Cybersecurity is an area that's going to hit everybody and already has. And you know, from a consumer and entertainment side, streaming and consumer adoption to content and what's happening with the media companies, and you know, again, AI and just data analysis is entering all of these companies industries in a way that hasn't been there historically. So you know, and not something we're directly investing in or touching, but you know, we're going to continue to see headlines about driverless vehicles and the like, and there's been a lot of capital going to those spaces as well. So, but certainly health, ag, and cybersecurity are big ones.
I'm gonna take a different tack and not talk about the specific industries, just the ecosystem as a whole. You know, to reference some of the other points, the money that's coming into Alberta and with more mature companies. So for a long time, outside of a few, you know, companies that have been referenced already, we were a startup ecosystem. We're slowly becoming a scale-up ecosystem. And that's where things get exciting, because once you have more exits from more founders or early employees who have capital to deploy, understand the space, then you've got a really active angel community, and it winds up becoming a flywheel. And so getting to that stage is going to be the most exciting. And we've been growing. And I mean, all of us here in the call know of companies that are now getting into the 9-figure valuations, right? As opposed to when you first start, and it's 7. And so, well, hopefully, we'll see. There's sometimes they can get away with a little higher. They get those valley valuations creeping up. But And then actually, John, you posted a comment there, and I can sort of speak from, I guess, Reach's side of things, as we're looking to scale our team primarily in Calgary. And there's actually big draws when it comes to the sort of cost of living, particularly property prices here, where we've been able to attract people from Vancouver, Toronto, not yet Montreal, but even Winnipeg to come out here. You know, there is a certain element of affordability that is here. And even though the option is to work remotely, and we'll hire somebody to work remotely in Vancouver, and they're like, but I can actually buy a proper house for the same price as a 1-bedroom condo. All right, sold. So, you know, it's really just sort of telling the story around Calgary. Edmonton's the same thing, you know, around Alberta. And combine that with the opportunity and everything else. And that's when you really get that ecosystem firing on all cylinders.
Great. Thanks, Kevin. Zach?
Kevin, that's what I wanted to say. Brilliant points. I really agree with Kevin on this. We at TNT, we're actually sector agnostic specifically, and we focus on the geographic area. So big focus on Alberta. We now also are focusing on Saskatchewan, but you know, really looking to help scale the entire startup community. And I think Kevin's right. We're in this phase now. We're transitioning from really just purely a startup community to a scale-up community. And I look forward to when I get to call up Mike Wilson and say, Mike, awesome job. Do you want to start investing with us now? And let's find some new great entrepreneurs that we can support. I look forward to that. And you know, the other thing, just on the topic of like trends and emerging trends, it's actually really exciting to be sector agnostic because we see all these companies coming into us. They're sharing their stories, they're sharing what they're working on. And little did I know before last spring that I'm actually really excited about pet technology. We invested in a dog walking app, you know, things like that. But we also invest at Startup TNT in like deep tech companies, like DrugBank's actually a spinoff from the U of A. We invest in a cellular agriculture company that then graduated from Y Combinator. So, you know, we're actually really excited about the entirety of the community here in Alberta. And that's the way we look at it, Eric.
Great. Thanks a lot, Zach. We're getting close to the end here. But before we head off into the sunset, I'd just like to see if there's any final comments from any of the panelists that you'd like to say something short and sweet to leave people with before we head off. Carla, it looks like you're...
Well, short and sweet, I guess it would be that there's never been a better time to invest in tech. The maturation of the industry, the willingness of every sector to adopt tech that can transform it, it created a perfect storm, and now is the time.
Perfect. I think that's a good place to end it at. So what I'll do, thank you so much to all of our panelists for joining us tonight. Thanks to our guests. I hope you learned something, found out something new. I will be sending a follow-up email this week just to get any feedback, what you liked, what can be improved, any questions that you had that we weren't able to cover, any follow-up that you want to have with any of the speakers. So I'll look forward to that. Look for that this week. But other than that, thank you all for coming tonight. I hope you have a good evening and a pleasant rest of the week.
Thank you.
Take care.